Good evening, everybody. It's 6 o'clock. Let's get cracking. The drinks aren't going to get any colder, or maybe they will, but in the ice. Thank you very much for coming out tonight. It's lovely to see everybody. It's very hard to believe that we're almost in October, end of a year, and what a crazy year it's been. I was just saying to everybody this morning that maybe the modus operandi from now on forward should be that actually we should expect a crisis every year, and if we don't get one, it's a bonus. But actually, if we do get one, then it's well, at least we're expecting it, because it does seem to be that we just roll from one crisis to the next. But what I really want to talk about tonight is it's a topic that's probably one of the most frequently discussed in South African financial circles, and that is really whether you should have offshore investments or whether you should have local investments. It's on the top of everybody's minds. It's a very not controversial subject, but it elicits a lot of blood pressure in people, and everybody gets very worked up about it. To the extent that if you follow some of the press, you'll see that some of the more popular commentators are having bets, and saying, well, put 500,000 here and we'll see who does better. And in our opinion, this actually really this muddies the waters, because actually there's a case to be had for having offshore and local investments. And today I actually really want to make a case for why you should have both. It shouldn't be an either-or kind of situation. You should really have both. So I really want to just discuss that and take you through some of the ways we do some thinking. And I'm going to start with making the case for offshore, because it's easy to make the case to have all your money offshore. You can have a look at this slide, and you don't even need to even go further than this to say, well, you sold me, you've made the case, let's all have another drink. SA is paralyzed by corruption, by infighting, by cargo deployment. You don't get service delivery. I mean, I was just listening to the radio this morning coming into work, and the topic of discussion is that the raw sewage that's flowing into the sea at Mshwanga, and that's a function of just poor service delivery. Obviously, Durban had the floods, but things haven't been fixed properly, and I don't suppose what really sinks into the powers that be is that people are not going to come to Durban for their holidays if they can't swim in the sea, because that's why you come to Durban. And then the tourism suffers, and all the other businesses suffer, And so you can understand people's frustration with this sort of situation. So you have infrastructure decay, which is exactly what we've just been talking about, and this leads to low growth. You have high government debt, and you have fiscal imbalances, and we've talked about the debt a lot of times. We have a skills exodus. We have people emigrating because they just get fed up, and then you have poverty and social unrest. And sure, that sounds like a pretty dire situation, and the outcome is really weak investment returns and people saying, well, I want to aggressively diversify, I want all my money offshore. So it's easy to make the case for offshore. And despite all this whole slide is 100% true. There's not one thing that you can argue with on that slide. But I want to argue that that is not the reason why you should be taking your money offshore. The reason why you should have some offshore investments is for the next two slides that I want to show you. The first one is this one. It's just a nice, pretty picture. And basically, it's the whole world, the economy of the world broken down into different sizes of the economies. So the bigger the block, the more important your country is and the bigger your economy is. So obviously, the US and China dominate up here in the corner. And you've got the rest of the G7 up at the top there. And then all the other countries sort of fit in here. And we're over here in the middle. I don't know if you can see South Africa there. So we're not right down here in the little mosaic at the very bottom where we're insignificant. We are significant, but there's a big wide world out there. And in our opinion, the primary reason why you want to have offshore investments is to diversify, because there are industries and economies out there in the world that we don't have access to in this country. And I want to show that here. So we have a lot of offshore investments. We've been doing it for sort of 12 or 13 years now. And these are some of our biggest companies that we own overseas. Most of the names will be quite familiar to you. We write about them quite often in Intuition or other places. But I just really want to show that some of the big holdings that we have overseas, there is no local equivalent. You can't have a portfolio of South African investments and invest in the same companies or the same industry or the same economic opportunity that you have when you invest overseas. So there's no local equivalent of Microsoft, unfortunately. It would be great if there was, but there isn't. Yes, on the mining side, we've got lots of mining companies, so we do cover that. And on Johnson & Johnson, we've got a few pharmaceutical companies, but they're not really the same as J&J. Aspen makes generic drugs. Johnson & Johnson obviously makes does the research themselves and make the primary drug that comes out. So Diageo, makes all the things that are on that table over there in the corner, most of them. I hope they're all Diageo products. But we don't really have liquor businesses in South Africa. We do, but they're not really listed anymore. And Distell, which was our one liquor company, is in the process of being acquired by Heineken and being delisted. We don't. Visa is another big company that we own a lot of. We don't have a payments network company in South Africa, and I'll talk a little bit more about it later. But it's a fabulous industry. And we just go down the list. So yes, I mean Walt Disney, Schneider, Yum, Nestle, ASML Holdings. We don't have those kinds of businesses in South Africa. And so everybody says, I want to diversify out of SA. I don't like what's going on here. But for us, it's actually got nothing to do with that. It's got everything to do with the fact that there are some great businesses and some great industries out there in the world that you really want to have and you really want to get exposure to. And then you can always say, if you want to diversify offshore, oh, well, the rand always weakens. And this chart shows that the rand always weakens over time. So if you want to use this argument to justify why you should have offshore investments, you can. I'm going to say to you later on, just remember the shocks. I'm going to come back to it right at the end. But the rand does weaken, but not always. And so I just want to remind you of some of the global themes. I've really been talking about this a little bit on the slide before, and we showed this slide in November or December last year, where we sort of highlighted how we build portfolios. So when we build portfolios, you'll be pleased to know that we don't just take a dart and throw it at the dartboard and say, "Oh, that's that." We do a lot of research, and there's some big themes going on in the world that you really want exposure to. There's some great ideas. There's some great secular trends happening out there that are driving the way we work, we trade, we live, we interact. So obviously the one is sort of consumer spending. Overseas, there's the aspirational consumer. People are getting wealthier. They spend their money in different ways. So yes, you can have the luxury goods, fancy watches and handbags and all the other bits and pieces like a Richemont or LVMH. But you can also have some very, very good quality, stable businesses like Coca-Cola. It's a great business. They don't really care what you drink as long as they make it. They don't mind if it's coffee or tea or water or fruit juice or fizzy drinks, as long as it's one of their products. All they want to do is make sure that when you drink something, it's one of their products. And it's a great business. You think that Coke is ex-growth and people don't want fizzy drinks anymore, but Coke is growing at a faster rate than ever because the companies reinvent themselves and they look for new opportunities. Then we talked about infrastructure. Obviously we talk about here and we can see things falling apart, and we're going to talk about this quite a lot tonight. But overseas, countries have been just as guilty of not investing in the infrastructure as we have been. Maybe not quite to the same extent. They still have power and things like that. But really, America hasn't built highways for 40 or 50 years. They haven't built airports. Their infrastructure is completely outdated. And one of Biden's bills that is going through US Congress at the moment is a sort of big infrastructure bill where they're really focusing on rebuilding the infrastructure, whether it's rolling out fiber or highways and ports and things like that. A lot of these developed countries are resting on infrastructure that was built 30, 40 years ago, and they haven't modernized. So there's, we can talk about us, but a lot of these countries fall into exactly the same boat. And obviously there's alternative energy at the bottom here in terms of where the world's moving at the moment. We write a little bit more about that in Intuition this week. And then obviously the whole digitalization impact, and there's lots of things that are sort of going on. So I was talking a little bit about Visa earlier on. Visa is a fantastic company. I'm sure everybody's got a Visa card in their wallet somewhere. I hope you do. It's MasterCard, tear it up. You must have a Visa card. But I was just saying to everybody earlier this morning, I was in the UK earlier this year doing a few touristy things for a change. And everywhere I went, I was not allowed to pay with cash. I had to pay with the card. I couldn't pay with cash. And even when I presented cash, they said, no, we don't take it. It's card or nothing. And that's the way the world is going, unfortunately. I mean, cash is still legal tender, but I mean, you can't pay with it. And so, companies like Visa or MasterCard, I mean, that's also a great company, are so well positioned to just capture this whole secular trend of people moving away from using cash to digital payments. It's safer, obviously it's more efficient for everybody. So yeah, that's really where the world's going. Another company that I just wanted to sort of highlight down here is like a company like ASML. You probably have never heard of ASML. It's not a household name. But ASML makes the machines that make computer chips. So you have companies that make computer chips like Samsung and TSMC, Taiwan Semi Manufacturing, or Intel, or NVIDIA, all those kind of companies. But ASML makes the machines that they buy to make the chips. And they're the only ones really in the world that do it. And so if you follow sort of the press, one of the consequences of the Ukrainian war is that the West has realized that not all the countries are friendly anymore. 90% of the world's chips are made in either Taiwan, China, or South Korea. So South Korea is all right, and Taiwan should be all right, but it does depend on what China does. And the US and Western Europe have realized that they actually need to make chips in America. It's American technology or it's European technology, but everything's been outsourced to Asia. And so there's a huge amount of demand coming for new factories, for new chips that are being built in America or Western Europe to mitigate the threat of using supply chain disruptions and war as a sort of currency of war almost. So there's all these things going on in the world that you cannot participate in if you just have a South African portfolio. And so in making the case for offshore, we really don't think that that offshore should be about running away from here. It should be about harnessing the opportunities that are out there that are exciting and they're great. But unfortunately, life is full of compromises. You don't get anything for nothing. I was telling everybody this morning that I live at Kogula, up the hill. And everybody says, when I say I live there, everybody says, oh, but you have such a lovely view. And I said, yes, we do have a lovely view, but the wind never stops blowing. It's always windy. There's always a cold wind. The doors are always slamming. It drives me absolutely nuts. So you don't get anything for nothing. Life is full of compromises. And the compromise on offshore is that generally valuations are much more expensive. So up until recently, inflation has been a lot lower, interest rates have been a lot lower. It is changing at the moment, but valuations have been generally a lot more expensive. And just remember these charts. I'm going to show you some other charts later that you can then use as a comparison. But in America, you're paying 20 times PEs for shares. In Europe, you're paying 15 times. And the other major compromise that you have to make is that offshore shares don't have nearly as much income as local shares. We're very lucky here. Our companies pay good dividends, and we've got a good culture of paying dividends and getting income. But what these charts basically show is that you get 2 times as much income from shares in South Africa as you do from offshore, double the amount of income, and you get 3 times as much income from local property shares as you do from global property shares. So it's a ratio of local versus offshore. And that's really the challenge, is that if you need income or you're relying on income from your investments, having offshore investments comes with that compromise of a much lower income stream than you get locally. So that's why we have a whole team of financial planners, because everybody's different and everybody's situation is different and nuanced. So one shoe doesn't fit all in this instance. But it's not to say that you can't have a combination, but that's why we're here to basically guide you and to tell you the consequences and what can be done and what can't be done. So that's very easy. You can make a case for offshore investments and you can say, sure, we should really have all our money offshore. And a lot of people over the last 5 years have said that. And they're very vociferous about it and get quite angry when you counteract it. But I really want to do now is say, can we actually make a case for SA? Because SA is a much harder case to make, isn't it? We live here, we look at the headlines, we see the raw sewage pumping into Umhlanga Beach, and our heart despairs and we think, oh, nothing ever changes. And I think the challenge in SA, before I go on to the next slide, is that your and I, mostly our interaction with government is at a municipal level. So we'll go, in Haik, it's wonderful, apparently. I think there's been a dramatic improvement in Haik, and for that we must obviously be grateful to the PA. But most people's interaction with government is through Home Affairs or your local municipal office, where you're getting licenses done, or you need a passport, or you need a birth certificate, or whatever the case is. And that service delivery is really poor. And then you've got no electricity, and then you've got water issues and things like that. And so your day-to-day experience of what government should be providing is extremely negative, and that frames your whole point of reference. When you read a headline that reinforces that message, it just sinks you further into despair, whether that headline is sensational or not. And so really what I want to challenge tonight is whether there is some change going on here that we're actually not aware of, and actually that's improving. And I really want to start with electricity. Now we might have, Claire pointed out to me that we have load shedding at 9 o'clock tonight. So please make sure that you get home before 9 o'clock. A, so that we can lock up before the lights go off and that you can get home safely. So yes, we've got load shedding in 2.5 hours. And so you talk about electricity and think, oh, well, you know, but how can you be positive when we're about to be plunged into darkness? But the point about load shedding is that actually the worse load shedding gets, the better it is. Now that sounds like a completely stupid statement, but the point is that when we got to stage 6 load shedding in June or July, thank goodness I was overseas for a couple of weeks over then, so I didn't bear the brunt of it. But the point is that it gets so bad, and the tolerance from South Africans is so thin that government was forced to implement reforms. And that's actually why you should actually view load shedding as a silver lining, because the worse it gets, the more urgency government is actually tackling the root of the issue, which is so long overdue. And there's a whole lot of points on the slide, but really last year there were a whole lot of reforms done in electricity. And some of the big ones were lifting the cap on producing your own power from 1 megawatt to 100 megawatts, and a few other bits and pieces. You know, when we fast forward to July this year, and we had the load shedding, Cyril announced a whole nother raft of reforms that have been desperately required that basically accelerate the electricity reform program in this country enormously. So first of all, that 100 megawatt that we raised last year has gone. That's gone completely. There's now an unlimited cap on, it's unlimited. There's no cap on what kind of plant you can build. You can go and build a mining company can go and build a 1 gigawatt plant if they want to for their own use. There's no cap on that. The other thing about some of all these renewable projects that are going on is that it's one thing to sort of say, okay, you don't need a license anymore, but then they had a whole lot of other rules embedded in the application process that you had to adhere to. And one of those rules was local content. You had to have 50% local content. They've scrapped a lot of those rules because they realized that some of those rules are simply not attainable. You cannot meet those requirements in a short space of time. And so by scrapping them, and they're probably not scrapped forever, but they have been essentially indefinitely scrapped for a couple of years. You can actually get these projects off the ground and getting built. And even in the last sort of probably 2 months, I think there's been 4 announcements of now solar projects that are construction has started on them already. You know, so it just goes to show when you actually remove regulation, and these reforms have been a long time coming. They're probably 20 years overdue, some of these reforms. And the problem is that we're also skeptical. We don't believe that anything's changing. But all I really want to leave you with tonight is that actually there is a lot changing behind the scenes. It has yet to manifest itself. I mean, obviously, you can start building a new solar plant today, and it's probably only going to come on stream in 18 months' time and get connected to the grid. So load shedding is not going away anytime soon. We're going to have load shedding for the next year or 15 months. But these reforms that they've passed are accelerating the end of our load shedding, and they really are. And some prominent economists and investment banks that we work with, they had basically forecast that load shedding would continue up until 2027. And on an optimistic scenario, they've said, okay, maybe it can now end in 2024. Maybe 2025 is a little bit more realistic. You know, so I'm not saying that load shedding is going to stop tomorrow. And if we have load shedding in a month's time and you think back to tonight and say, oh, Michael was talking absolute nonsense. Don't think that. Look ahead, because what we're doing is looking ahead and seeing that there's actually finally some light at the end of the tunnel. And electricity really is a massive, massive opportunity for us. And I'm going to explain why in a moment. And there's other things going on as well. When you've heard us talk about spectrum, the stuff that makes cell phones work, 5G spectrum is really, really important. It's very efficient. It's much more efficient at carrying data around. Cell phone companies can deploy it. Obviously get those efficiencies, and because it's so much more efficient, you can then bring down the prices of data and make cell phones and data more affordable, which obviously opens up a massive opportunity for everybody. You know, good internet is almost as necessary as good electricity or water these days. You know, and so the spectrum has been auctioned. It raised 14 billion rand for the fiscus earlier in the year, which is money that government can certainly do with. And cell phone companies are now rolling out 5G aggressively. So you say that nothing's happening, but things are happening, and that's a That's a huge bonus. We've been waiting 15 years for spectrum to be auctioned in this country. Since 2006, I think we've been waiting. And it happened in March, finally. Also on Transnet, if you read Intuition this week, we sort of talk about a bit of coal. It'll come out tomorrow morning. You know, coal should be railed to Richards Bay and exported through the Richards Bay coal terminal, which has worked very well for years. Because of Transnet's inefficiencies and the fact that the railways are not working at capacity, there's another 400 trucks on the road every day carrying coal to Durban. And we deal with it every day because we have to go to Maritzburg and the highway's a nightmare. And so we don't go anywhere because we're too scared to get on the highway. But that's one of the consequences of Transnet not maintaining the lines. And listen, it's not all their fault. I mean, you know, cables get stolen all the time, but that's another issue sort of for law and order. But even notwithstanding the issues that Transnet is facing, they have shortlisted 10 bidders, 10 worldwide companies, all massively reputable companies, to invest in the Durban container port and the Ngura container port. You know, so I mean, these are not Mickey Mouse companies. It's Dubai Ports World, and it's the guys in Singapore and in China. And to modernize our ports and make them efficient it would be a massive leap forward in terms of improving the logistics in this country. So there's also been bids for private sector railway operators on the Durban to Joburg line and on the Joburg to East London line. Sorry, I'm skipping ahead here. So there is stuff going on in Transnet. It's also, it takes time, but as I said to you last year, the first hurdle is for the mindset to change, that actually the private sector can help. Then you've got to go through all the regulatory process and issue the tenders and go through the whole process, change the laws and everything like that. That takes time. But the mindset has changed and the process is firmly underway. And that's what I think is so important, because over the next year or 18 months, we're going to see these things come to fruition. It's not going to happen tomorrow, but the train is rolling, to use a very bad pun. So why is it so important? Why are these things so important? Why do we harp on about it all the time? So Treasury obviously do a lot of work on this. National Treasury is extremely competent. And they basically, well, they don't believe, they know that our economy can only really grow at about 1.5%. All the constraints we have in our economy, we haven't got electricity, we haven't got, you know, good railways, we haven't got this, we haven't got that. We can only really grow at 1.5%. Just remember that number. I'm going to talk about it a little bit on the next slide. If we do all these reforms that we're talking about and the government's talking about, we lift our growth rate to 3.5 to 4.5%. That's the potential that we can grow. It's not to say we will grow at that, but that's the potential. We lift the whole potential of this economy to grow faster. And that's why it's so important. So I'm not saying that we're necessarily going to start growing at 4.5%. But what these reforms do is create the capacity for the private sector to come in and actually start investing and lifting our growth rates. And when you'll see how important that is when I show you this slide here. So this is our growth rate for the last 22 years. And you can generally see the blue lines taper off from the left to the right. They start quite big and they get smaller and smaller. And the red dotted line that sort of goes across there is just the average growth rate over different periods of time. So up until 2009, even including the financial crisis in that sort of period, we grew at an average of 3.6%. You know, you'll remember in the lead up to the World Cup, you know, 2004 to 2009 were pretty good years in this country. We grew on average at 4%. The stock market did extremely well in that period. Companies delivered huge earnings and dividends, and everything was going okay. Even in the period after the financial crisis, up until the end of 2013, we grew at 3%. Yeah, the market continued to perform very well. What happened after that, sort of when I suppose state capture really got going and Zuma got settled into to power, was that our growth rate collapsed. And then, you know, 2014 to 2019, we grew at less than 1% over that period. The last 2 years is probably a little bit unfair. We've grown at 0, but that does include COVID, where obviously all the refunds come in. If I'd actually, the last period, I'd actually made one the whole period instead of 2, we probably grew over the last 8 or 9 years at 0.7%. Now, that goes back to my slide previously, where the maximum potential growth rate in this country is 1.5%. We were growing at 0.7, 0.8% a year. And you can just see essentially how anemic that is and how companies have struggled to sort of get going. And why that previous slide is so important is that you're lifting the potential growth rate back to sort of 4.5%. Now, that's not to say we are going to grow at 4.5%, but even if we get to sort of 2.5% growth, it's going to be a substantial improvement on what we've had over the last 8 or so years. And we honestly think that we're going to get there. And it's not wishful thinking. It's based on all the evidence that we see for us. So I just really want to sort of show you this slide before I move almost onto the closing thing. And this is GFCF, stands for Gross Fixed Capital Formation. It's a very long fancy term for basically how much fixed investment happens in a country. And basically there's a rule of thumb that you should be investing 20 to 25% of your GDP in fixed investment every year. So fixed investment is water, roads, airports, machinery, cell phones, everything, fiber, you name it. All the stuff that basically makes a country work. Now, you can see up into the lead up into the World Cup in 2002 to 2010, that we had the surge in fixed investment. Obviously, we did highways, we did the Gautrain, we did new airports, we did new stadiums, all things that we enjoy still today. And imagine where Joburg's roads would be if they hadn't done that Gauteng improvement project way back then. I mean, I know the e-tolls are still an issue, but if they hadn't widened all those Joburg highways back in 2006, 2008, imagine the chaos that Joburg would be today if they hadn't done that. So there was a whole period of fixed investment, and then ever since, it's just basically collapsed and got less and less and less, and there's been no investment in this country. And you can see it. Things are falling apart, and we complain about it every day, and you don't really have to be a genius to understand that trend that's happened there. But look what's happened over the last 3 or 4 quarters. And this is data from the Reserve Bank. I'm not making it up, I promise. There's been a noticeable turnaround in fixed investment in the last basically 5 or 6 quarters. So you can see it if you drive to Durban. Obviously, it's a horrible road, but at least they're widening the road, and once it's done, it'll be magnificent. And that's what infrastructure is all about. You improve the infrastructure, you make things more efficient, you bring down the cost of doing business, you allow people to expand and to be efficient and to take that opportunity. But what's as important as this chart on the left is the chart on the right. And the chart on the right is exactly the same chart as the chart on the left. It's got exactly the same pattern, but it just breaks it down between what the public sector does and what the private sector does. And you can see the public sector is the bottom blue bar, and you can see there's a little uptick, there's a tiny little uptick at the end there, and that's things like SANRAL spending on the roads, which they haven't done for a long time. So now suddenly we have got quite a lot of road projects on the go, which is wonderful to see. But what's so important here is this uptick in the light blue bar, which is the private sector. Because the whole thing about what's happening in electricity and in ports and things is that the government, through its reforms, is basically saying to the private sector, we actually finally realize that we can't do everything ourselves, and we are asking the private sector to come in. And there's plenty of money in the private sector. It's money waiting to be spent. They just need the right regulatory environment and the reforms to be done before they can spend it. And that is what's going on at the moment. So if you said to me, well, all these reforms, and basically we're still going to rely on Eskom and Transnet to deliver the growth, I would be sitting here saying, I'm very skeptical that it's not going to happen. But when we sit here and say the reforms are happening and we're allowing the private sector in to come and invest in power and rail and things like that, I'm much more confident that's going to happen. A, because we talk to all the companies all the time, and they're telling us that they are busier than ever and they're seeing opportunity and they are harnessing the opportunity. And what we see in the press and what government is doing, they are seeing in their businesses, and it's creating opportunity for them. So I'm very, very confident that this uptick in private sector investment is actually happening, and it's not just a pie in the sky. So I just want to give you one other example here, sort of before I close. Bidvest. It's a huge company. As I said this morning, it's got fingers in 1,000 pies, and it actually even makes pies, as you can see here. It's actually got a business called King Pie. But Bidvest is more part of your lives than you probably realize. It owns hundreds of different companies, active across freight, logistics. It sells cars, it cleans your offices, it provides the bushes in your offices, it does foreign exchange, it does all sorts of different things, and obviously sort of a bit of food service and all sorts of different stuff. So it's Cecil Nurse and office furniture, and you go through those and you probably see a couple of logos and things, and you think, oh, I didn't realize that was owned by Bidvest, and I use that company. So Bidvest is, and why I've chosen this example is A, because it's in most people's portfolios. It's a great company. It's been a great South African success story. Also B, because it's really a South African company that's got fingers across the whole economy. So how they perform and how they operate really, they cannot, well, can they operate and can they perform if the economy is as dire as everybody says? So let's just look at what happened to Bidvest. Now, before you get concerned and think that the whole world fell apart and they had this Steinhoff moment back in the middle there, Bidvest was listed in 1998, I think, or late 80s or early 90s. And actually the first business in Bidvest was a company called Chickens, which did catering supply. So, you know, if you're delivering food to restaurants and things like that. And Bidvest grew and grew and grew. And in 2016, it got so big that they decided to split the company into two. So now you have Bidcorp, which is all the food service businesses. So that's a global business that delivers food to restaurants and hotels and restaurants and everything else knows what. And then you have the rest of Bidvest, which is all the essentially the old South African stuff that was left behind. And that's McCarthy's and the freight, logistics. They operate terminals and harbors and all the other bits and pieces that I mentioned to you on the slide. So the red line, so the blue line is basically the Bidvest share price. And then in 2016, they split into two companies. So the red line is basically the two companies combined. And you can see that Bidvest essentially is trading at an all-time high at the moment. The red line. And the blue line is actually the Bidvest share price alone. So that's just the portion that was left after Bidcorp was separately listed. And you can see that Bidvest, it fell during COVID. It's back to sort of where it was. But really, it's gone sideways for sort of 5 or 6 years. And I just want you to remember that as well. The share price has kind of gone nowhere since 2017, 2018. And now we're sitting in 2022. But let's have a look. So Bidvest had their results last week. And as I said to you, this is a big company that spans the whole economy. So before the company split in 2016, the company generated 9.6 million rand of profit. And it was split between essentially what was Bidvest and then what became Bidcorp, all the food stuff in that ratio. So Bidvest actually made about 5.6 million rand of profit, and Bidcorp the balance, roughly 4 billion or whatever it is. Last week they reported their profits, and what was left in Bidvest this year made more money than what the whole company made 7 years ago before they split into two companies. So my question to you is, can they actually do that if the economy is as moribund as people say? Because Bidvest spans everything that we do. And if you look at the dividend as well, the reason, so that was the combined company up there, 900 cents per share. And then obviously it took 2 years for the dividend to rebate, because basically they split on the 1st of June and their year ended at the end of June. And so in the first year, in 2016, the interim dividend was for the combined company, and then the final dividend was split between the two. And obviously, as the months rolled by and the next interim came out, the dividend rebased. And yes, the dividend collapsed during COVID, as all dividends did. But now Bidvest this year has paid out 750 a share, which is significantly higher than where it was when it unbundled Bidcorp 6 years ago. So Bidvest is a great company, right? I want to show you, I'll show you something, and really my challenge to you on that is that, can they do that if the economy is so moribund? And you know, we stand up here and we often say that companies are not countries, and this is really an example of that, is that despite what happens in our country, companies are charged with going out there and finding the opportunity and seizing the day. And that's exactly what Bidvest has done. So again, like we did overseas, I just want to remind you of some of the things that are going on in this country and some of the themes that we identify. So again, we don't just throw the darts at the dartboard. We've got five core themes that we really focus portfolios around. These are the things that we think are going to define how SA performs over the next couple of years. So you've got the supported consumer. So I think everybody in this country, in this room, probably would be very surprised at how buoyant the informal economy is in this country. It's a hugely buoyant sector. There's a huge amount of activity that's unreported in this country that doesn't show up on all the national statistics, and yet people in townships, they hustle, they bustle, they do things, and they actually make a living, and sometimes quite a good one. And obviously that does interact with the formal economy from time to time. You will buy your goods from a ShopRite or a Boxer. You know, taxi drivers will buy their taxis from Bidvest or whatever the case is. So obviously they do interact, but actually at the bottom end of the market, it's actually far more buoyant than what people give it credit for. And there's a lot of companies that can benefit from that activity. And then we've got infrastructure and reform, which I've talked about a lot tonight already. And there are a lot of companies. I mean, there's just a handful of companies on here that we've demonstrated they're going to benefit. But there's a lot of companies that are going to benefit from the revival of our infrastructure and this reform that is going to drive it. I mean, you know, I've put then a bank here in the reform category, and you might think, well, how is a bank going to benefit from electricity reform? Well, the banks are financing all these new projects. So, you know, the banks are absolutely key in providing finance to all these projects. Their loan growth goes up. They obviously earn more interest. They earn transaction fees and all those kind of things. And the banks actually do extremely well out of it. And then there's the sort of pockets of excellence and things that we always have in this country, where we've got some great companies that thrive despite it. And I want you now to think back to sort of Bidvest and the fact that they're making record profits this year, and yet the share price has gone nowhere for 5 years, did I say? You know, now that's really frustrating from our point of view. We've invested in a great company. It's very frustrating from your point of view too, because you've invested in a great company. Yes, the Harvard House approach, we've got higher dividends, and the dividends come from R5 post unbundling to R7.50, which is great. The share price has gone nowhere, because what's been happening in South Africa, and just ignore this little spike up here because it's essentially COVID-related data that distorts things. But over the valuations peaked in 2017, early 2018, when essentially that sort of coincided with the Steinhoff debacle, and that's kind of when really state capture really, I suppose, came to the fore and everybody realized how pervasive it was. But since over the last 5 or 6 years, South African shares have been in this massive derating. The PEs have dropped from an average of 22, 23 times down to 10.5 times where they are today. Now that is a massive derating, and that's why even despite companies doing quite well, raising their profits, FirstRand came out with profits today with their results. They've never reported higher profits. They've never reported this higher dividend, and yet the share price is 20 or 30% lower than where it was 3 years ago. And yet they've never ever done better than what they did for the last 12 months. So it's not to say that FirstRand is doing anything wrong. It's the market that's not appreciating how robust these companies are. But at some point they will appreciate it, and that's the whole point. At some point it sort of filters through. So South African shares are on sort of 10.5 times evaluations. Think back to my earlier chart of overseas, where US shares are on 20 times and European shares are on 15 times. So our shares are half as expensive as American ones and a third cheaper than European ones. And that's the benefit. Even on the dividend, you know, our shares generally across the whole market, and obviously there's some shares like Naspers that hardly pay a dividend. On average, our shares are yielding 4%, which you can't really get anywhere else. So South African shares are really cheap. And so to make the case for SA, I really want to sort of say that, you know, it's easy to make the case for offshore. Everybody says, well, you should be offshore. This country's got no hope. But what really makes share prices move is when reality differs from expectation. At the moment, I liken expectation to the sort of grade 1 hurdle race at the local pre-primary school. The hurdles are about this high off the ground, and even the little kids can barely jump over them, and you know they sort of waddle down the field. Expectations are extremely low, and there's so much skepticism in this country about what can be done and what can't be done. And that skepticism is manifesting itself essentially in this PE ratio, where shares are really cheap. And if you really think about it, what's happened over the last sort of 2 years is that, or 3 years, is that actually a lot of shares have been delisted. So I'm just going to mention a couple. So I mentioned earlier that Distell was being bought by Heineken. You'll remember that 2 years ago, Pioneer Foods was bought by Pepsi. Imperial, which is obviously one of our really large logistics companies, was bought by Dubai Ports World earlier this year, and the list goes on. I mean, I could go on for probably 5 minutes of all the companies that have been listed, delisted and bought out by other private companies. And so why would they do that? Why would Heineken come in and buy Distell if they thought that there was no growth here? They see plenty of opportunity. The problem is that the South African investment community doesn't see that opportunity. They're so skeptical that they don't see it. And unfortunately, you sort of wake up and then, you know, a private company will say, well, you know, I'm prepared to pay X amount for that company. If you guys are not, well, that's your problem. You know, and then I think South African fund managers are actually waking up to the point at the moment that actually there's some really good companies here, and they're very, very undervalued, and hopefully the attitudes are starting to change. And I really wanted to just finish off on the rand, and I had the chart of the rand, and yes, the rand does weaken consistently over time, because that's exactly in line with economic theory. Economic theory says that a currency should weaken by the difference in inflation between the two countries. Now, I just want to blow our own trumpet for a moment. We have got lower inflation than anywhere else in the world. UK inflation hit 12% last month, and lawyers in the UK are striking for pay increases of 25% at the moment. You know, we actually only started 15% and then put all the unions down to 6 or 7 by the time we finished bargaining and striking and things like that. But in the UK, they're striking at 25% levels at the moment, because they haven't had inflation like this really since the early 70s, and they don't really know what's hit them. So yes, the rand does weaken consistently over time. And at the moment, I mean, the rand versus, if you look at the rand versus the dollar, it's almost at its weakest level, not quite ever. During COVID, it got to a slightly weaker level. I'm sorry, I should have made some of these bars a little different color. But the dark blue bar heading up the side there is the rand versus the dollar. And the rand versus the dollar is almost at its weakest level. But that's because the dollar is so strong against every single currency at the moment. The dollar's on steroids, and it's because of what America's doing in terms of their own inflation and what they're trying to do to combat inflation. But just look at the chart on the right here. This is major currencies around the world relative to the dollar this year. And yes, we've fallen there. There's South Africa in the middle there. We've lost about 8% against the dollar. But oh gosh, the pound has lost 15%, and the yen has lost 20%, and the Australian dollar has lost 7.5%. So I think we're all so guilty of looking at our own situation, or looking at South Africa, and saying, and and the commentators, will highlight that the rand's lost 7.5% against the dollar this year. They're not wrong; it has, but if you don't have the context and the fact that every single currency has lost money against the dollar this year, you're not making an informed decision about what you really want to do. Another example is Growthpoint. Growthpoint had their results yesterday, and we all know that office vacancies in this country are a problem. There's too many offices, and obviously people working from home has been a big trend. So Growthpoint's office vacancies are about 20%. Last year they were 21%, and the headline this morning is, the office sector is in SA is absolutely decimated. Growthpoint has vacancies of 20%. What they don't say is that actually the vacancies last year were 21%. So actually there is an improvement. It's not to say that there's not a problem in the office market. Yes, there is. But if you don't have the context of where you're coming from or where you're going to, you can take that one headline and completely misinterpret it, which I think is what often happens. So I really want to leave you with the conclusion that all these headlines are from the newspaper over the last 2 weeks, but not one of those newspapers is a South African newspaper. They're all from around the world, and I really think that what we're sort of sitting here really saying at the moment is that we don't think that all our problems in this country are over. Far from it. We've got plenty of problems to go around, and they'll keep us busy for years and years and years. But what we are saying is that expectations in this country are at rock bottom, and valuations are at rock bottom, and the grass is certainly not always greener on the other side. There's actually a lot of problems out there in the world at the moment, and everybody is suddenly experiencing exactly the same issues that we're experiencing. We actually used to them, and we know how to deal with them. We know how to deal with load shedding. We know our electricity prices go up 15% every year. It's not a problem to us. We've learned to live with it. So all we're really saying is that we do think that you should have offshore investments in your portfolio, because there's some wonderful opportunities around the world that we simply don't have access to. But don't go offshore because of my first slide. Go offshore because there's opportunity offshore. But there's equal opportunity here, and we are getting increasingly confident that over the next year or two, that's going to start manifesting itself. There's a lot of talk in the press about optimistic economists and things like that, and some of the commentary is basically saying, oh well, we don't believe it. And I think you're right. I think that's the real problem in this country, that everybody's so skeptical. But the counter argument to that is that part of our job is looking at all the statistics and saying, well, what's going on? The other part of our job is to go and talk to the companies themselves and say, what's going on? And then putting the two together. And when we put those two together, there's a lot more activity than you would give credit for from the statistics. And there's reason to be optimistic that the future can be a little bit brighter than the past. That's really where I want to stop. Thank you very much. I think I've talked for plenty long enough. We haven't seen everybody for a little while. Claire's going to get a microphone, so I'm very happy to answer any questions if there are questions. But as usual, we have delicious snacks and drinks for a hot evening. So please, if you don't have the courage to ask a question now, please stay and join us for some drinks and snacks, and the whole team's here, and we can certainly chat and catch up with everybody. It's lovely to have you here. I just want to say thank you for coming out. I think the other consequence of COVID is that people have become quite hermitish and they don't really want to get out. So it's lovely to see everybody. I hope there's some friends in the audience and you can catch up with other people besides us. And thank you very much for coming out. It's lovely to have you.